What's up, everybody? Welcome to the Stocks channel. My name is Cory, and in tonight's episode I'm doing another stock market technical analysis update. But before we crack open these charts, you know what you gotta do. Go ahead and smash that like button and subscribe to the channel to follow along with all of my updates. Now first up is the ticker symbol SPY, which is the SP500 ETF. So let's crack open this chart and see what's going on in the stock market today. Alright, so on the SPY ETF, we did close up 0.5% today, and we still see the price action struggling in these resistance areas. Remember, we're now in a short-term bearish trend, and we know that because the price action is closing below these moving averages that used to be support levels, and now we see them acting as resistance levels, and we also see that the 5 EMA has crossed below the 13 EMA. Now the SPY ETF did close above the 5 EMA today, but it's still closing below the 20 simple moving average and the 13 EMA. Those are bearish signs that the price action is struggling in these areas. We also see that the price action is hovering about a 0.382 Fibonacci retracement from the drop. So remember, in the correction that we're expecting to see a bounce followed by a further decline. And right now, we're going to get benefit of the doubt to the next decline, closing these gaps, which will bring us somewhere around the $325 or $327 range. Now, there's still a chance that that level breaks down and we come down lower. But right now, I am expecting to see that area act as a very strong support level. So I would expect to see a short-term bounce after we get to that area. So right now we're still in this B bounce wave, and it's getting very choppy as we see the price action just sort of chopping around the 50 EMA and the 20 simple moving average. So if we can close up back above these levels of the $342 range and have that 5 EMA cross back above the 13 EMA, that'll tell us that this trend's going back to the bullish side and the correction is possibly over. But right now it's too soon to say that, and we have to give benefit of the doubt to the short-term trend, which is still bearish. Now, if we go over to a 1 hour chart, we also see here that we have failed to form a higher high on the day because the last high we had was on September 9th, and that was around a $342 level, and today's high was somewhere around $341. So we're still about $1 shy of forming a higher high, which tells us that we're still in that downward trend because we're forming lower highs. So this is a very pivotal area we're in, and the Fed is getting together at 2 p.m. to let us know what their further fiscal policy is going to be. And I would expect to see that act as a significant catalyst to tell us if we're going to see explosive move to the upside or the downside. But right now the trend is bearish and we have to respect that. And as boring as it sounds, we really just need to wait for this trend to tell us what direction it's going to be. So let's go ahead and jump over to the Nasdaq 100, and we're looking at the QQQ ETF or the triple Qs. And we do see the same story with the Nasdaq 100 with the price action failing to close above the 13 EMA, and it's also closing below the 20 simple moving average. And we still have that short-term bearish trend because that 5 EMA is trading below the 13 EMA. So we're still in a short-term bearish downtrend on the Nasdaq 100 as well, and we do see a Fibonacci retracement level of 0.382 also acting as resistance. Now that level is right around $281, and we are still also trading above the 50 EMA. So right now we're expecting the same thing with that ABC correction, and we would expect to see further downside before we say that this correction is over and that bullish momentum trend can continue. So remember, in the short term, we have a bearish trend, but in the long term, it is without a doubt a bullish long-term trend because we have been running in a straight line up since the crash in March. So just because we're in a short-term bearish trend doesn't mean we ignore the long-term bullish trend. However, if this correction turns into something more and we continue to break through these support levels, the bearish trend can pick up, and if it's prolonged for any amount of time, we could be entering into a bear market. But right now, it's way too soon to say that we're in a bear market. We just have a short-term correction trend that we need to acknowledge. So right now, I would say protect your capital and be aware that there is more downside potential that we cannot ignore because the trend is telling us that it is a downtrend. We also have a lower high on the 1 hour chart on the Nasdaq 100, and we see a failure to break above those highs from September 10th. So the Nasdaq 100 is in a very similar boat as the SP 500, and we cannot ignore the fact that we have lower highs. So on the Nasdaq 100, we do have support levels at the 50 EMA, which is about $270, as well as support at 269 and 264. In any event that those support levels fail, we would probably come down to this Fibonacci retracement level of $250, and that is why I said there's still some downside risks that we have to be aware of. We also see the Bollinger Bands are flattening out, and that's telling us that the trend is becoming neutral after an upward trend. We also see the same thing with the 20 simple moving average flattening out, which is also confirming that the trend is becoming more neutral, and a neutral trend could go in either direction. It could go back to a bullish trend and continue that upward strength, or it could reverse and we could see a bearish trend beginning to start. Next up is the Dow Jones Industrial, and we're looking at the DIA ETF. And the Dow Jones did close above its 13 EMA again, because it did also yesterday, but it failed to close above its 20 simple moving average. So we also see the trend becoming very neutral on the Dow Jones with the Bollinger Bands narrowing out, but we are in that short-term bearish trend with the 5 EMA still trading below the 13 EMA. Now the Dow Jones is probably looking the best of all because it is closing above these moving averages and they're no longer acting as resistance, but we still have to acknowledge the fact that it's failed to close above the 20 simple moving average. So the Dow Jones has one more moving average it must close above, and we still have to see that 5 EMA cross back above the 13 EMA before we're going to get bullish on this market again. The Dow Jones is also retracing more than a 0.382 Fibonacci, and it's looking like it's more likely to hit the 0.5 Fibonacci retracement from its low. So it does seem like the industrials in the Dow Jones are looking a lot stronger, but it's still in that trend, and we still expect to see further correction the same way we're expecting to see in the other indices. But on the Dow Jones, we have gaps that are much lower than we see on the SP 500. So these gaps don't have to get closed now, but they are something we need to pay attention to. And as you typically see, these gaps will get filled eventually, and they're really not that much lower before we see them get filled. So the bears may take an attempt to close those gaps in any event that the Fed says something that the market panics about. So on the DIA ETF, pay attention to the gaps at $268 as well as $264. Next up is the VIX, which is our fear indicator. And we do see the VIX struggling to hold its bullish trend, today closing down about 1%. Now with today's close on the VIX, we did close below the 20 simple moving average, and we're starting to see that 5 EMA cross back below the 13 EMA. Now that could be signaling that fear is leaving this market, but we are still at that inflection point where the VIX could bounce off these levels of support and hold this bullish trend. In one more day, we will know what the VIX is going to do. So if you're not sure what to do in this market right now, just be patient for the rest of this next day or two, and we're going to know a lot more information that's going to tell us which direction this market's going to break. But right now, the VIX is kind of playing games with us, and it's still hovering around that inflection point of whether it's going to bounce off of support or whether this trend is going to break down from a bullish trend and turn into a bearish trend. So let's take a look at some of the sectors driving the market. And first up, we do have the financials, and financials had an absolute terrible day today, closing down negative 1.36%. Which means that the financials are failing to break into a bullish trend with that 5 EMA staying below that 13 EMA and the price action closing back below the moving averages again. Now it's still trading above the 50 EMA, but we also are still finding resistance at this resistance trend line, which means the financials have still yet to form that higher high. And in a bull market, we need to see price action forming higher highs. So if the financials continue to break down and close below their 50 EMA, watch out below, because the stock market's not going anywhere without the financials. And if we want to see the SP 500 make new all-time highs, we need to see the financials join in on this bull market. The next sector is the industrials, and the industrials are absolutely looking the strongest of all, closing well above the moving averages. And we do see that the 5 EMA has broke back above the 13 EMA. So overall, the industrials are back into their bullish trend, and they're still following this very bullish trend line that we have here in green. And you can see the price action walking up really nicely in this steady incline. So that shows us there could be money entering the industrials, maybe rotating out of tech and other sectors. And right now, industrials is starting to look like it's picking up some strength and picking up some steam and continuing its bull run. The industrials also didn't correct very far before continuing their rally, and that's a great sign of strength right now. But I still think we need to see those financials join in on the fun, and it's going to be hard to believe that industrials and these other sectors are going to continue to go higher if the financials go into a bear market. The next sector is the healthcare sector, and we see today there was not that much action, only closing up 0.13%. The healthcare sector is still closing below the 20 simple moving average, and that 5 EMA is still trading below that 13 EMA, so we still have a short-term bearish trend. So we still need to wait a couple more days on the healthcare sector to see if it's going to continue an uptrend or if it's going to continue its downtrend, but we do see lower lows and a lower high forming on the healthcare sector, which is always going to tell us that we're in a bearish trend. Next up is the US dollar, and we're looking at DXY. And we do see the US dollar still holding up on support, holding up right about its 13 EMA and still trading above its 20 simple moving average. We also have a bullish short-term trend on the dollar with the 5 EMA trading above the 13. And remember, if the dollar continues to grow in strength, we're going to expect to see the stock market continue to correct. So right now, we have to wait a couple more days to see if the dollar is going to break out and form another higher high. But right now, this trend is showing strength. We do have that higher high already in place with a bullish trend, and we are trading above the 20 simple moving average. So right now, I would have to give benefit of the doubt to the dollar at least coming up here and testing this 50 EMA. And if we break back above that, look out for strength returning to the dollar, because the dollar will officially be in a bull market and it will be ready to go for another bull run. Next up, let's take a look at gold. And we see gold today coming up and hitting our resistance level from this previous high and getting rejected, but ultimately still closing above its moving averages, and it's still in a very small bullish trend because that 5 EMA is just barely trading above that 13 EMA. So we don't see a lot of follow through in the gold bull market, and we still haven't formed that higher high that we're waiting to see, which makes sense because the dollar is also holding up around a support level. So I wouldn't expect gold to be blasting through resistance levels when the dollar is still holding up at support levels. Remember, we expect gold to go higher if the dollar goes lower, and with the dollar showing some recent strength, it doesn't surprise me that we're seeing gold struggle to break through this resistance level. So look out for gold to break above resistance, and if it does come back down to our support level and fail to bounce, I would be a seller of gold, because look out below, because that support level has been a very strong support level. As you can see, this level has been support all the way back to August 11th. So that is a very strong support level, and if it does break through to the downside, that would be a sell signal on gold. Let's take a quick look at our FOMO stocks, and first up we have Apple, and we do see Apple went absolutely nowhere today, going up only 0.16%, even though it opened well above its closing price. So we do see a lot of sellers in Apple still, which is not surprising because we saw Apple get FOMO'd into and go parabolic during the stock split. We have Apple still in a short-term bearish trend, and we still see Apple struggling to close above its 13 EMA, and it's still trading below its 20 simple moving average. So ultimately, the short-term trend is still bearish on Apple, and we are still expecting an ABC bounce that would come back down and close these gaps. So there's still a lot more downside on Apple, and I would not be a buyer at these levels until we see how low some of these stocks are going to go. So right now, Apple has gaps at $106 and $96, and those should be significant support levels, but I do expect to see these gaps close before Apple resumes its bull market. Our other FOMO stock, of course, is Tesla, and Tesla had another great day today, going up 7%. Now, this is still in line with an ABC correction. Even if Tesla is having this nice B-wave move, it still needs to prove to us that this is going to be a reversal of the bearish trend. And it is starting to do that with today's price action, because we did see the 5 EMA cross back above the 13 EMA, and we did see it close above the 20 simple moving average. So right now, if you want to be a buyer of Tesla, you're really looking to see if this 20 simple moving average is going to act as support in any event that Tesla starts to come back down. You would wait and watch for a bounce before ultimately trying to catch a trade on Tesla. The problem with chasing Tesla right now is this could have been a false breakout of the bearish trend, and we could see Tesla break right back down through these support levels and continue its corrective C wave. So as we know, Tesla has a lot of FOMO and it has a lot of popularity with investors, but that doesn't mean you want to be chasing it and FOMOing into it. So right now, remember, September is still that correction month, and we want to be a little defensive in September, and we want to watch to see what's going to happen with the price action before ultimately deciding what positions we want to take for the remainder of the year. So another thing to note on the SP 500 is we did go up 0.5% today, but it was also on lower volume. So we still don't see any evidence that that smart money, aka that big money, is piling back into the stock market. And if anything, they're getting ready to sell again into this strength. So remember, an ABC bounce psychologically makes sense, because that smart money is not trying to sell all their position in one day and crash the stock market. So now that the market is seeing a short-term bounce, I would expect to see volume increase on selling days again, but right now we're seeing volume decreasing on up days. So that's still in line with a correction, and that's still what we would expect to see on the B wave of a correction, is a bounce on lower volume. So it's very clear here that the volume started to decrease during the correction, and right now that's in line with saying that we're still expecting to see that C wave down before ultimately saying that the correction could be over. So on the S&P 500, look out for those support levels at 330 and at 327. And if those break down, look down here for the 0.382 retracement at $305. So please remember to smash that like button on that video to help me out. I really hope these videos are helping you out. And if you want to follow along on all of my technical analysis, remember to subscribe to my channel. So thanks for watching, everybody. And as always, I will see you in the next episode.